Hello, everyone! As we begin a brand new trading week, things may seem calm on the surface. The broader markets are quiet, but underneath that stillness, one particular name is stirring up a storm. Dvlt AI, ticker symbol DVLT. The company's stock just wrapped up one of its most dramatic sessions in recent memory. It closed the previous trading day at 1.69, marking a massive 24.26% gain in a single session. But the excitement didn't stop when the closing bell rang. In after-hours trading, the stock pushed even higher, adding another 2.37%, settling around 1.73 before the market went dark for the weekend. Now, to most traders watching from the sidelines, that kind of move screams speculative momentum play. After all, 62 million shares traded hands, an enormous figure for a company with such a small market capitalization. Many see this as just another low-float, high-volatility lottery ticket. The kind of stock that skyrockets on hype one day and crashes back to earth the next. They look at the 52-week low of 0.25 and the 52-week high of 4.10, and they assume it's another pump-and-dump pattern, a quick gamble with no staying power. But when you look deeper, the story becomes far more complex and far more interesting. This sudden surge isn't just a random speculative frenzy. The data, the company's filings, and a string of press releases that the market had largely ignored until now tell a very different story. Friday's explosion wasn't a fluke. It may actually represent a delayed, violent revaluation by the market, one that reflects a company that has quietly changed its own trajectory over the past week. In doing so, Dvlt AI may have painted a big, bright target on its back, attracting both eager bulls and determined short sellers who now see the stock as a battlefield. Let's start with the obvious. For months, DVLT has been dismissed by many as just another small-cap AI stock, one with a catchy name, a low share price, and limited institutional backing. And that's not entirely wrong. Institutional ownership sits somewhere around 2 to 4%, depending on the filing you read. That's tiny, meaning the stock's movements are driven almost entirely by retail traders, individuals reacting to news, chatter, and social media sentiment. That's why DVLT can swing 38% in a single trading day, moving from 1.23 to 1.72 like it's nothing. But what many traders missed is that this wasn't just noise. The move was fueled by real news, 3 major announcements within a single week that completely redefined what this company actually does. Let's rewind the clock. On Thursday, November 6th, Dvlt AI revealed a partnership with Rodney's Comedy Club. On the surface, that might sound like a small, quirky deal, AI meets comedy, but dig deeper and it gets interesting. The company announced that it's integrating its proprietary Verify You joke token and audio-based authentication technology into the live comedy space. That means comedians can now copyright jokes in real time, create a measurable laugh index, and even get verifiable digital credentials for their performances. It's a fascinating real-world example of how AI and blockchain can merge to protect creative intellectual property, something artists, writers, and musicians have struggled with for years. And yet, when this news dropped, the market barely reacted. Fast forward 2 days earlier, to Tuesday, November 4th, and we see the headline that should have woken everyone up. Dvlt AI had signed a $10 million exclusive worldwide licensing agreement with Selex Holding Company. This deal is no joke. It centers around the tokenization and monetization of genomic, DNA, and biopharma data, some of the most valuable data on the planet. Beyond the $10 million upfront, the agreement includes up to $2.55 billion in potential milestone payments tied to future sales and performance targets. Yes, you heard that correctly. Billions in potential value. And that's not all. Just a day before that, on November 3rd, Dvlt AI announced yet another partnership, this time with NF Hits and Music, to create a blockchain-based music and content distribution network. At the same time, the company terminated a prior acquisition that no longer fit its strategy, effectively cleaning up its balance sheet and tightening its focus. So, when the stock jumped 24% on Friday, it wasn't random hype. It was the market finally catching up, waking up to the reality that this tiny AI company had just signed a multi-million-dollar global deal with multi-billion-dollar potential while commercializing its technology across multiple entertainment and data industries. Now, that raises the question, what exactly does Dvlt AI do? For a long time, that question had a vague answer. But now, the company's direction is becoming much clearer. Dvlt AI is an AI-driven data monetization company. It builds digital infrastructure for the Web 3.0 ecosystem, a world where data isn't just collected, but owned, verified, and traded like an asset. Its technologies include audio and acoustic-based data transfer, digital credentialing systems, and data scoring algorithms that can assign value to things we've never been able to price before, like personal data, intellectual property, and digital media rights. Their platforms, such as Data Value and DataScore, are designed to assess and validate these non-traditional assets, and their newly launched data exchanges, covering real-world assets, corporate data, political donations, and name-image-likeness rights, are essentially the marketplaces where these new digital assets can be tokenized and traded. In short, the company isn't just selling ideas, it's building the infrastructure for the data economy of the future. Historically, the problem has been monetization, turning those ideas into real revenue. But recent guidance from the company indicates a turning point. Management expects $12–15 million in revenue for the second half of this year and projects between $40–50 million by 2026. When you combine that with the $10 million Selex deal, it's clear that the numbers are finally starting to matter. But every strong bull story attracts its skeptics, and in this case, those skeptics are very vocal. The surge in price and volume has drawn a wave of short sellers, traders betting that the stock will fall. As of the latest data from NASDAQ, 9.7 million shares are currently sold short. The borrow fee rate, the cost to borrow shares for shorting, sits at 11.57% annually, a clear sign that there's high demand to bet against the company. That's not a cheap bet to make. And when the cost of shorting gets that high, it can set the stage for something explosive, a potential short squeeze. The short thesis, however, is straightforward. Critics believe this is still a cash-burning company with a history of dilution, using flashy partnerships and buzzwords to inflate its stock. They argue that the $2.955 billion milestone potential from the Selex deal is more of a dream than a guarantee, and that any excitement will fade once the next filing or dilution hits the market. On the other hand, the bulls see this as a true inflection point, a company that has finally turned its ideas into contracts and its concepts into hard numbers. This is where things get dangerous. When you have legitimate news fueling bullish momentum and aggressive shorts pressing down on the stock, the result is a powder keg, a market setup that can create massive volatility in both directions. Publicly available fails to deliver data from late September already hinted at heavy short side pressure, with millions of shares failing to settle on time, often a sign of intense shorting activity or logistical strain in the clearing process. If that pattern continues while short interest grows, we could see some serious fireworks. For retail investors trying to navigate this situation, here are a few key points. First, learn where to find short interest data. Platforms like FINRA or NASDAQ update those numbers twice a month. Watch the days to cover ratio and the total shares short. Second, track the borrow fee rate. If that 11.57% rate starts climbing higher, it means the short side is getting more crowded, and the pressure for a squeeze could build. Third, remember that chasing a short squeeze can be one of the riskiest plays in the market. Stocks like this can make huge moves upward, and just as quickly crash back down. This is why it's important to stay grounded in the fundamentals. Yes, Dvlt just announced a string of impressive partnerships and fresh revenue guidance, but it's still a small-cap stock with limited liquidity and a speculative investor base. You have to know what you're holding, and why. On social media, the debate is raging. Some retail traders see the $4.52-week high as the next target, calling for a coordinated push to force shorts to cover. Others are warning that this kind of movement can create an echo chamber, one that feels powerful, but often ends in losses for latecomers. The truth probably lies somewhere in between. The only sustainable long-term move comes from fundamentals, not hype. And right now, those fundamentals are starting to shift in Dvlt's favor. It's also worth noting that the connection with Selex Holding runs deeper than most realize. Filings reveal that Selex already owns about 5.36% of Dvlt AI. That means this isn't just a licensing deal, and it's a strategic partnership with shared financial interests. Selex's success is now directly tied to Dvlt's success. So where does the company go from here? Optimistic investors believe Friday's rally was just the beginning. They see the stock's recent low of 0.25 as ancient history and view the $4.10 high as an achievable target, especially if more deals like Selex follow. The single Wall Street analyst covering Dvlt currently has a buy rating with a $3 price target, suggesting meaningful upside from current levels. But bears see it differently. They expect management to use this rally to raise capital, diluting shareholders again. They predict the price could slip back below $1.50 before the year ends. The truth is, both sides have valid points. Dvlt has proven it can land high-value partnerships, but it still has to execute, generate sustainable revenue, and manage investor expectations in a volatile environment. This stock has now become a live experiment in what happens when disruptive technology, bold deals, and intense short pressure collide. Whether it becomes a lasting success story or another flash in the pan will depend entirely on how the next few quarters unfold. So, what do you think? Are the shorts underestimating the company's transformation, or is this rally setting up for another collapse? Share your thoughts in the comments, stay informed, and remember, in markets like this, timing and discipline matter more than hype. This is not financial advice.